Hello and welcome to Livewire Markets. My name's Tom Richardson and today I'm sitting down with Geoff Wilson, the founder of Wilson Asset Management. Geoff, it's great to have you here.
Hey, good to be here, Tom.
You've been active on social media platform X in your opposition to unrealised capital gains tax, the potential for that legislation. Just wondering, what is it about X, or what was formerly known as Twitter, that you kind of enjoy? How does it help you reach people?
Yeah, well, nearly a year ago, I was in the US for a month or so and seeing various fund managers, etc. And saw Bill Ackman, saw Bose Weinstein from Saba, one of the activists, and some of the more traditional managers. And what you find over there, they're big communicators on the old Twitter or X. And I'm not a big social media person. I like, when I used to read you writing at the Financial Review, I'd like to read the hard copy. I tend to be that way inclined. And to me, going to social media was a big jump for me. But what I did find on X is, if you're interested in finance, the information and the speed at which you get that information is exceptional. In Australia, I think the FinTwits, as they're called, continue to grow. And there's a good community there, and it's a really good way of collecting information and also communicating. So, I've enjoyed it.
Okay, so if you're out there watching this, give Geoff a follow for sure. And one of the things you've been talking about on X a little bit and at Wilson Asset Management is your opposition to this proposed tax on unrealised capital gains over $3 million, I think.
Yeah, in the super funds, which was a proposal that Labor put up. Unfortunately, it's bad legislation because initially when they announced it, it was just taxing on realised gains, increasing the tax rate on realised gains in self-managed super funds above $3 million. And what they realised is the big industry funds in the first day actually can't calculate on a per person basis. So the big industry funds said the only way we could calculate it if we tax it on unrealised gains. And what that does, it potentially destroys a whole segment of the Australian market. The risk capital, there's nearly $1 trillion in self-managed super funds. It's really an attack on self-managed super funds. Originally, we weren't going to be vocal at all on that. Historically, we've been vocal on the unfairness and illogical strategies around, the Labor has had about franking credits. But this, because it's just, from our perspective, it's the thin edge of the wedge. Once they start taxing unrealised capital gains, then it could, well go from super to various other areas. And the interesting thing is Paul Keating, hasn't come out publicly, but the man who created, effectively superannuation in Australia, he's privately he thinks it's bad legislation as well. So the good thing is, good or bad, it looks like we're going to an election. So it didn't get through the Senate. After the election, depending on who is in power, whether they try to bring it back again. If the Libs are in power, then it's a dead duck.
Okay, so I've heard the Wilson empire might be growing a little bit. There's talk in the media that you might list a new investment company, the Wilson Income Maximiser Fund. So Could you lift the lid on that?
Yeah, and the good thing is we just lodged the prospectus, so I can talk about it. We're looking to raise a little over $500 million, and it's in a listed investment company. As you said, WAM Income Maximiser, the ASX code is going to be WMX, and what it'll do, it'll provide monthly income to investors, franked to the extent we can frank it. We're talking about, in the prospectus, 6%, but historically, what this strategy's done has done a lot better than 6% on a grossed up basis, on a per annum basis. And what it's really trying to do is fit in where, very disappointingly, APRA has decided to get rid of bank hybrids. So it actually is going to be a hybrid. It's going to be equity and debt in terms of what we invest in. It's going to be mainly focused on high quality Australian companies for the equity and high quality Australian companies for the debt. And it'll be about 60-40, 70-30 equity debt. So it'll be a hybrid play. of equity and debt, and give you monthly income and give you it's a lower risk strategy than 100% equities. And in terms of debt, it's going to be the tier 1 and tier 2 debt that we invest in, and the high quality debt.
And who'll be running the fund?
We've got Matt Helpt, who's looks at a lot of our macro and the large caps, and he's joined with a team. There's an ex-RBA person, Damien, who's joined us, and we've got plus the rest of the team, because the equities is the top 300. It'll actually be a different portfolio to what we've been investing in historically, because it's just got different characteristics. And the guys have been on the debt side. Matt, before he joined us, was trading the debt, and also on the board. We've got a really high quality board. Kurt Zuber, who used to be the treasurer at Westpac for 15 years, and Joanna Fisher, who's chair of Colonial First State. So it's a really high quality board.
So it's Damien Bowie you brought over
Correct.
from Barrenjoey?
Very good, yeah. We bought him from Barrenjoey, but and he was Credit Suisse before that, and Reserve Bank before that. I used to trade debt and.
Yeah, he was fantastic on macro. Always.
Exceptional.
Yeah, exceptional.
Exceptional on macro, and really has Matt's had a good relationship with him for a long time when he was on the sell side, and we brought him over to the buy side, and add significant value there.
Okay, let's talk about stocks and markets a little bit. Big theme everyone's talking about in local market is banks valuations. CBA in particular, I think when it reported its results, was trading on a trailing PE of about 26. I don't think the analysts are expecting much growth ahead. I think the dividend yield was 2.9%, so pretty low. You get more actually in a savings deposit at CBA than 2.9%. So what's your view? What's been driving this kind of valuation appreciation in the banks?
Yeah, I think there's been a lot of passive money that's gone into the banks. Also, I think there's a lot of the big industry funds that have been fully invested overseas and have some of their active money in Australia. Some of it they manage themselves, and some of it they give to managers in Australia. With all the Australian managers being effectively short the banks by having underweight positions, then as they get a new dollar invested in their fund, they're full on their global exposure. So where do they put it? Where do they put their own money that they're investing, besides the money they've got with the active managers? Because the active managers are underweight the banks, then they tend to be net buyers of the banks. So I think it's been passive. It's not fundamentally. People are saying, "Oh, look, the banks are cheap. Let's buy them." The banks, by any valuation as you put it, are expensive, and over time that'll sort itself out. Maybe with what's happening in the market at the moment, we're getting a little bit of that adjustment happening.
Sure. Maybe we could just touch on passive funds a little bit, these index tracking funds. There's a lot of talk that they are kind of distorting the market, inflating valuations artificially. I went to a lunch actually a couple of weeks ago with a big Australian hedge fund, and they were kind of openly boasting that they would, front run the market, and that they'd attempt to buy these kind of small companies before they got added to the index, and then sell them after they got added to the index, kind of profit from that price gain. I mean, do you think passive index tracking funds, are they distorting the market, do you think?
100%, and there are a lot of opportunities. For the active manager, there are, as you just pointed out, there's a lot of the index plays. If something's going into the ASX 200, there's going to be a free kick there, because there'll be the passive money that'll flow into them once they go into the index. So there's been a lot of that. And the volatility, the reporting season we've just had, to me the volatility has been significant, where and a lot of that's driven by quant or passive. So to me, is there a position for active managers? There is. There's probably a bigger position as more money becomes passive.
What advice would you have for young people starting out in the market in terms of picking stocks? How should they go about that? And perhaps, are there any investing mistakes you think that people make that they could kind of learn to avoid?
Okay, if people are really starting out of the market, the most basic way is buy an ETF, and you're just getting exposure to an index, and you really don't have to do much research to do that. To me, the interesting one is an area that we've spent a lot of time managing money in is in listed investment companies, and I sort of call that the thinking person's ETF, because you have to do a bit of research. You're getting a portfolio of shares similar to an ETF. But you've got to do a bit of research, and maybe you'll have an opportunity to buy $1 worth of assets at 80 or 90 cents, and then hold them when and get the market performance plus them moving from the discount to NTA to NTA. If you want to do a bit more research and look at individual companies, then I think it's very important that you focus on an area that you might have an area of expertise in. I remember years ago I was giving blood. And I was talking to I was at the Mater Hospital, and I was talking to the nurse there, and she asked me what I did, and I said, I work in the stock market. She said, I know nothing about the stock market. And I said, who do you work for? And she said, the ultimate parent company I work for is Sonic Healthcare. And I said, look, what are they like as managers? And she said, they're exceptional managers. I said, well, you actually know more about Sonic Healthcare than I do. I hope she did buy shares. That was a long time ago, and they've done extremely well. So to me, if you can do a bit more research and decide what companies you'd like to invest in and why, and obviously have a thesis behind that. In terms of mistakes, I think when I was a lot younger, I always thought people talked about time in the market, versus timing of the market. And when I was younger, I was a big believer in timing of the market. At the moment, things are a little bit negative on the market. Maybe this is a good time to buy, or try to buy when the blood runs in the street, and sell when everyone's saying the market's going to go up forever. So I was more focused on that. But the longer I've been in the market, the more sort of ups and downs I've seen, the more research I've seen that, say over the last 20 years, if you missed out on the best performing day each year, so 20 days over 20 years, then the money you've invested in the market would have virtually gone nowhere. And if you'd been in the market for those only 20 days, but the best 20 days in those 20 years, you would have got a performance of around 8 to 10%. So I suppose as I've got older, I've really realised that it's time in the market rather than the timing of the market. That's probably the biggest thing I've learnt over that period of time. In terms of my outlook for the market going forward, I think it's the market has had a great run. At the moment it's going through a bit of a correction. It wouldn't surprise me if there's a little bit more pain to come. Particularly in terms of what's happening in the US. You've got the new president over there making some significant decisions. We all know that increasing tariffs is inflationary. The amount of money that's been taken out of the system, with Elon cutting staff, stopping various funding that has occurred historically, that will have a multiplier effect in terms of negatively on the economy. So I'm a little bit nervous on the economic impact that the various initiatives of the new presidency are putting in place. And even though there'll be the drop in the corporate tax rate, I'm just a little bit nervous that the economy mightn't be as strong in the US as people had previously anticipated. And what I wonder is whether the market over the last couple of weeks, we've seen the equity market come off. I think the Magnificent Seven, I think they're off like 12% plus. There could just be, we might be going through a little bit of adjustment in equity valuations.
But if there is volatility, stay invested.
Exactly, that's what I've learned. That's what I learned, because is today the bottom or is today the top? We don't know.
Okay. Geoff, that was absolutely terrific. Thank you very much for your time.
Thank you, Tom.